Mazdadealers.com.
Nearly 90% of taxpayers are expected to take the standard deduction this year, and that may sound like our taxes just got easier, but filers should be aware of some major changes to the tax code. Joining us tonight is financial professional Mike Kojonen from Principal Preservation Services. Nice to see you again, Mike.
Thanks for having me, Jeff.
So what are some of those changes we were talking about for the tax season this year?
Three big changes. One is the standard deduction. That's gone from $12,700 for married filing jointly to $24,000, which is causing a lot of people not having to do the itemization, and it's a shorter process. But don't just take that for granted and assume that's going to be the best way for you, because instead of itemizing, have your tax professional run two scenarios. One taking the big standard deduction, one taking the itemization where you can deduct your mortgage interest and charitable giving and things like that, and find out which is going to be best for you. Don't just take it for granted.
And you talked about also earlier some sort of a new filing form people should look out for.
Yeah, they get rid of the 1040EZ, the 1040A, now it's just the 1040. So just supposedly it can be a simpler form, make it easier for everybody. Nothing changes where the filing date is still April 15th, so that's about it for the change on the form. The next one is the child tax credit.
Yes.
That's doubled to $2,000 for children up to age 17 in the household. If they're between 17 and 24, there's a smaller credit of $500, but pretty generous ability to be able to deduct that child tax credit. If you're a single filer, up to $200,000 of income, you can deduct $2,000 per child. Married filing jointly, $400,000. What I like about credits now, it's way different than deductions. Your deductions reduce your taxable income, but credits deduct what you owe to the IRS. If I owe the IRS $4,000, and if I only had two children, I would cut my bill down to zero. So credits are a good thing.
I think everyone would like the sound of that, especially hardworking parents. Now, is there anything we can deduct even if we are taking that standard deduction? Yeah, these over-the-line deductions, we call them. There's a few big ones, like people who are self-employed can deduct their health care premiums. You can deduct that. Educational costs can be deducted. But the two big ones here is your HSA and your IRA. So health savings accounts, you can deduct up till April 15th this year for your deduction health savings account. But remember, not everybody can have a health savings account. You have to have a high deductible health insurance plan to qualify. And also for your IRA. So you have till April 15th to make your IRA contributions for last year. So if you're under age 50, $5,500. If you're over 50 years old, $6,500 for your deductions. I have a whole list of other tax information on my website. You can download a tax guide on my website, though, at Principal Preservation Services. Now, amidst all those changes, what are the things that people don't have to worry about and just are staying the same?
Yeah, maybe you took a loss last year. The market took a little bit of hit. So maybe you have a capital loss. That stayed the same. You can deduct up to $3,000 of capital losses each year into the tax year. Maybe you're a teacher and you buy some school supplies. You can deduct up to $250 of unreimbursed school supplies. If you're paying student loans, up to $2,500 of interest if you qualify for that as well. But some big ones are another credits, which we like credits. Again, is adoptive credit, which is almost $14,000, and the electric car credit, which is pretty high as well. You get a nice deduction on that, or credit on that.
And of course, sales for electric cars are continuing to go up.
Absolutely.
So for people to think about.
Yeah.
All right, Mike, thank you so much for joining us as we navigate tax season. If you'd like to watch these tips again, just go to WCCO.com.